Dear students, welcome to my channel. In this video, let us discuss the different types of Provident Funds. Provident Fund which provides for the future. So if any fund which is created for the benefit of the employee in the future, it is said to be or it is coming under the broad title of Provident Fund. It is created by the employer, and towards it the employer as well as the employee may be contributing to it, and it will be credited to the employee's account, and at the time of the maturity or at the time of the retirement or even in between, if the employee in need of money, he can receive it, he can take from that value. Such an arrangement, it is said to be Provident Fund. Mainly there are four types of Provident Funds. The first one is Statutory Provident Fund, second one is Recognized Provident Fund, and third one is Unrecognized Provident Fund, and the fourth one is Public Provident Fund. Let us discuss each one of these Provident Fund and its tax implication. So the first type of Provident Fund is Statutory Provident Fund. These Provident Funds are set up, created under the Provident Fund Act 1925. It is created for the government employees, semi-government employees, employees working in local authorities, universities, etc. And the taxability of the amount contributed, the employee's contribution will be taxed at the time of contribution, treating it as just the application of his salary, and the employer's contribution will not be included in salary at the time of contribution. And every year he will be eligible for getting a deduction of rupees 1,50,000 as per section 80C. At the time of maturity, any lump sum amount received, either it is contributed by the employer or by the employee, that both the amount will not be taxed at the time of the lump sum receipt. So this is the features of Statutory Provident Fund which is created under the Provident Fund Act 1925. With respect to the Recognized Provident Fund, the Provident Fund Act 1952 applies. That is the second type of Provident Fund. Any Provident Fund which is set up under the Provident Fund Act 1952, and if it is recognized by the Commissioner or Chief Commissioner of the Income Tax, then it is said to be Recognized Provident Fund. And it is the obligation of the employer to set up a Provident Fund account if he is having more than 20 employees employed in his organization. And this fund must be recognized by the Commissioner or Chief Commissioner of Income Tax. Rule 4, Part A of the Schedule 4 has laid down 7 important conditions. If that conditions are satisfied only, the Income Tax Department would give the recognition to this kind of Provident Fund. First condition is, all employees shall be employed in India or shall be employed by an employer whose principal place of business in India. Secondly, a definite proportion of the salary of an employee shall be deducted from his salary at the time of each periodical contribution to the employee. The fund shall be vested in 2 or more trustees or in the official trustee of an irrevocable trust. The fund shall be consist of contributions as stated above, and the interest credited on such contribution, and of the securities purchased therewith, and of any capital gains arising from the transfer of capital asset of the fund. The employer shall not be entitled to withdraw any sum from the fund except under specified circumstances, and that too only his own contributions and the interest thereon. And finally, the accumulated balance due to an employee shall be payable on the day he ceases to be an employee of the employer maintaining the fund. So these are the important 7 conditions laid down as per Rule 4, Part A of the Schedule 4. So if these conditions are satisfied, the commissioner or chief commissioner would give recognition to the Provident Fund. Then only it would be said to be a recognized Provident Fund. And the contribution made by the employee towards recognized Provident Fund is taxable. And if the contribution made by the employer towards this fund in excess of 12% of the salary of the employee, that to be taxable every year. And if the interest received in excess of 9.5% from the recognized Provident Fund, that excess portion also to be taxed. A maximum amount of rupees 1,50,000 shall be deductible under section 80C while computing the total income. The lump sum amount received at the time of retirement or cessation of the employment is not taxable, provided if the employee has served with the employer in a continuous service of 5 years. If the employee has served 5 years continuously with that employer, the amount received from the recognized Provident Fund is not taxable. If not, it is taxable. But there are certain exemptions. If the discontinuance of service of 5 years, if it is a reason beyond the control of the employee, then it need not be considered that 5 years. Under that circumstance, even the service is less than 5 years, it need not be taxed. For example, because of the ill health or because of the closure of the business, under such circumstances, the amount, the lump sum received from this recognized Provident Fund is not taxable. Next type of Provident Fund is Unrecognized Provident Fund. These are types of Provident Funds set up or created, but it is not a statutory Provident Fund nor a recognized Provident Fund. And these funds may be recognized by the Provident Fund Commissioner, but it is not recognized by the Commissioner or Chief Commissioner of the Income Tax. So such Provident Funds are said to be Unrecognized Provident Fund. If any amount contributed to this Unrecognized Provident Fund, the contribution made by the employee is taxable at the time of the contribution, treating it as the payment from the salary. So it is taxable at the time of contribution. But employer's contribution is not taxable at the time of contribution, but it will be taxed at the time of receipt of the lump sum amount. 80C deduction is not eligible for Unrecognized Provident Fund contribution. And at the time of the lump sum amount received, in this there are 4 components, that is employee's contribution, interest on employee's contribution, employer's contribution and interest on employer's contribution. 4 things are there. In that first one, that is employee's contribution, that will be exempted. Interest on employee's contribution taxable under the head other sources of income. And employer's contribution and interest thereon to be taxed under the head salary at the time of its receipt. So I would repeat that if any amount received from Unrecognized Provident Fund, it would be classified into 4 categories. That is employee's contribution, that is exempted, and interest on employee's contribution taxable under the head other source of income, and employer's contribution plus the interest thereon, that too taxable under the head salary income. So these are the conditions for taxability of amount received from Unrecognized Provident Fund. So the last type of Provident Fund is Public Provident Fund. These type of Provident Funds are started in 1st July 1968 in India, and every individual is eligible to open a public provident fund, and the minimum amount needs to be contributed is 500 rupee, and he can contribute a maximum of rupees 1,50,000 in a financial year. The payment could be in lump sum payment or single payment, or it may be installment payment, but a maximum of 12 installments only would be allowed. And any individual can start this provident fund in his own name, or in the name of the children, or in the name of a minor for whom he is a guardian or parent. He can start a provident fund. It can be opened and operated through State Bank of India or through its subsidiaries or the 13 nationalized banks which are authorized by the central government to open and operate public provident fund. And the contribution made by the individuals are eligible for deduction under section 80C to a maximum of 1,50,000 in a year. The withdrawal from the public provident fund is possible after the completion of 6 years, but it would be limited with part withdrawal, but there are certain conditions for the part withdrawal, and the amount could be fully withdrawn once the 15 years of completion. If the individual is not intended to withdraw, extend the investment for block of 5 years, and during that block of 5 years he can withdraw maximum of 60% amount. So the part withdrawal also possible from the public provident fund once it completed 6 years, but there are certain conditions for the withdrawal from the public provident fund if it is part withdrawal. The full withdrawal is possible after the completion of 15 years. At the time of the full withdrawal, the individual is not liable to pay any tax for the money received from the public provident fund. If the individual is intended to continue the provident fund, he can continue his provident fund for next 5 years. So during that block of 5 years, he can withdraw an amount equivalent to 60%. And again, if he want to continue, then he can go for another 5 years after the completion of that block. The lump sum amount received from the public provident fund is fully exempted. So dear friends, these are the different types of provident funds, that is statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. Hope this video is useful. Please prepare theory questions based on this video, so it may be asked for the exam. What are the different types of provident fund, and which are the rules laid down in the part A of the schedule for getting the approval for a provident fund? What are the conditions, taxability of unrecognized provident fund? How a provident fund could be opened and operated through State Bank of India or any other banking institutions? Or suppose a person not having employment, whether he can start a provident fund? These kind of questions can be answered based on this video. If you are not subscribed to my channel, please do it. If you have any questions or clarification required, please leave it in the comment box. Thank you very much.